All right, so we had a very disappointing jobs number today that led to an interesting move in the market. It kind of led to a inflation move in the market. So I'm going to break down what that means, kind of how the market responded to this jobs report. Probably not the way it was, kind of more a little bit of a risk-off type move, but not the way that you consider. And like I said, with a lean towards inflationary expectations. So we're going to talk about what that means, how that showed up, what that means in terms of our expectations going forward, and especially considering again this mature rally we've been on, and how that rally might continue to mature, what it will look like going forward, which stocks might benefit and which stocks won't, as we have already seen here today, at least which sectors. So I'm going to break all that down. We're going to take a look at a trade idea of a stock that did break out, had a really good move today. It's got a lot of the breakout patterns that we're not seeing in this small cap index, which a lot of people are considering in a breakout mode. And so we're going to see the difference there and talk about how to trade that individual stock with our trade idea of the day. So let's go ahead and get started. Today is Friday, September the 3rd, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see a little bit of a down day, small down day, but you notice just very small ranges again. 2/3 of the average was our range, and that's a very, very low average range, like extremely low. So continuing on that theme, yesterday was 21 points. Today it's 20.15 points. Before that, 15. Before that, 15. And then 23. Monday was our biggest range of the week. So really, really light range on the week. In fact, if you take a look at the weekly market forecast after getting the cluster last week, the near-term line staying up there, we only had a 32-point range all week long. That's a very, very, again, the average daily range is 30 points. So put that in context. The average daily range for the S&P, which is an extremely low average daily range. In fact, if you look here, you can see how low that is. Here we'll come to SPX. You can see here, like we are at 0.65. The ATR is 0.65% of the price. That's a very, very, very low level. We haven't seen for a long time. I mean, down to like 20, going into the COVID low point when we were right about 0.65, and that was the low point that we had. So very low level on an average basis. And then so that's the average daily range for the S&P 500. So then when you look at the weekly range for the S&P, with a very strong posture, we had as much of a range for the entire week that is the average on a daily basis that is extremely low. As it is, right? I mean, again, compared to that 4,500 number, right? Typically, a 1% would be 45 points if we were at 1% of that, which would be kind of like in that normal range. So to be at 65 basis points, at 30 instead of 45, kind of shows just how extremely low it is, and that's what our weekly range was. So very, very light. Like last week's range, which was pretty small too, was at 63 points. You can see we had a 43 point there, we had a 67 there, we had a 57. These are all small ranges in the 57, 67, 43, 112 on that week on options expiration, but then 63 and then 32. And again, you might expect that on the holiday week, but this isn't. Next week's the holiday week. Next week's the 4-day week. This was going into a holiday week, but dang, very, very light. Very small range, and really you wouldn't expect that to. I mean, as long as we keep grinding higher, that's the kind of moves we'll get. Like as long as the averages keep coming down here, we're going to get even smaller and smaller ATRs on an average basis. And you notice we're not very far off the moving average. We're less than 2% off the moving average. So we're barely grinding up here. You can see when we really break out, we're typically 3-4% above the moving average when we're really breaking out on a new bullish run, coming off of like that actual intermediate low point. Over here, we were coming off the Nasdaq's intermediate low point. We were up 4%, 4.25% when we broke out and started this last leg. We're only 2%, so we're not going to be breaking out here, but we're also obviously not falling. We're just grinding higher, and you can see the Russell 2000. Again, when it breaks out, of its bullish zone. You can see you get up to 7%. Over here you got up 7% and higher, 8%. We're only less than 3% above the 30-day moving average. So again, very similar to June 8th. There's a lot of comparisons out there. I'm seeing a lot of tweets from really good chartists that I follow that are comparing this current move to the early June market. Well, the early June market looked like it was going to break out. The intermediate line got above 80. The near-term line got up there, but we couldn't, we weren't very far above the moving average. We weren't getting breakout signals. We're very, very similar to that now. In fact, you can see we have this bearish divergence with lower highs, with obviously much, much higher highs, and we're getting a lot higher. We're pulling away from the divergent low point without getting new higher near-term peaks. Now, granted, this is a bullish intermediate confirmation signal. Again, the last one we got was just right there. We had a 2-day rally coming out of that. So we could very well rally out of this. Now, again, we've been on this near-term run for a while. 7 to 10 days is your normal run. And we've been, what, 1, 2, 3, 4. Really, it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days on this current near-term rally. So we're probably getting towards the end of this near-term run rather than, say, the beginning of it. Again, that's on the Russell 2000. On the weekly chart for the Russell 2000, you can see the near-term line getting to very, very high levels a week after the momentum line had gotten to really high levels. So a very strong move last week on the Russell. And then we follow up 112-point range, very, very good and getting above the 30-week moving average. We follow that up with a 49-point range, right? So again, when you go back to the breakout week here coming off of that September low point, we were well 17% above the 30-week moving average. And we had, a 100-point range. And we followed that up with 53, 43, and then down. But then really when we broke out right there, that's when we really broke out on the daily chart, coming off of the Halloween low point, 126, 97, 58, 75, 78. And again, all on 1700. Now we're at 22 and we're at 49. So 49 is a much different number compared to 2200 than it is compared to 1600. So very, very low ranges, not following through like you would like to see on that Russell 2000. Let's see how the weekly chart ended up looking like here on the Hakunashi candle. Still, you can see, I have to zoom out so you can see that Hakunashi differential down there. It's still relatively low. This is a normalized number, so you can compare this all the way back. It's still relatively low to where we've been on this, again, the initial part of the breakout mode. You can see we're still very strong PPO there at 8%. The Russell 2000, the PPO has stopped falling, and we got a good bullish Hakunashi candle this week right there, breaking back above the 50-day moving average. Next week's candle is probably going to open up around 2250. We're already trading at 2292. So we're going to start off next week with a pretty good bullish candle too. Again, the Hakunashi size of that candle is at 3% there. You can see that June 8th was close to 3%. It was at 2.5%. But again, going to that weekly chart here in the beginning of November when we broke out, it was up to 5-6%. So this is, you want it to be up here when you're really breaking out, not at these lower levels where, it doesn't look like it's breaking out. See, we had some good bullish candles there coming off of a bearish little bit of some weakness there. Let's take a look at the 3 green arrow charts. Whoops, not that one. Let's look at this one first with all 4 of them. There we go. You can see 3 green arrows except for the Dow. The Dow still doesn't have the 3 green arrows yet. Never did get the green arrow on the MACD. But you notice the MACD histogram for the S&P, the NASDAQ for the last 3 days, and then now the Russell, the MACD is turning lower on all of them. Very high, very overbought stochastics. Even the Dow has got most at 75. It's just barely in that above 75 range. But the Dow has been a lot more sideways here for the last few weeks. Yet the Russell has been the most bullish, and you can see that histogram is starting to roll over. Now let's take a look at the 2-line versions. There's your S&P 500. You can see the MACD histogram has already peaked. It's been pulling down, so that now looks like the actual MACD itself is peaking. So you start to look for bullish convergence. Again, you can stay above the 17-day moving average for quite a while you are converging. So it doesn't have to drop, and I don't think it will. IWM, you can see it looks like its MACD might be peaking. MACD histogram, which means that the MACD itself will be peaking here soon. Again, the same thing. Watch for the convergence. Are we going to drop back down as fast as we moved up, or are we going to slowly converge while we stay above this rising 17-day moving average? And for that matter, for the most part, the 8-day, right? And then just breaking the 8-day on the near-term pullbacks and flirting with the 17-day. So as of right now, that appears to be the case. So I don't expect big pullbacks yet, right? Of course, one will be coming. It's like the earthquake here in Utah. You know one's coming. But until then, you can see, I think we'll just get slow grinds higher while we get these bullish convergences going on. If you take a look at the other oscillating charts, we're above 60. We're not above 100 anymore on SPX. So kind of keep an eye on that convergence. Same thing with the Russell. We actually are back below 60. Again, same thing that we saw here. We didn't even get above 100. Well, we did barely got above 150, but not on June 8th. It was a divergence there, and when we got above 60. Same thing here. We didn't get above 150. We barely got above 150 there, but much less 200, which is where you prefer to get on a breakout, right? So again, not quite a breakout move like a lot of people might think it is. You look at the directional movement index for the S&P 500. We are back below 30 in the positive indicator. We're still below 20, so you still have a rising ADX. But the IWM, you can see we're above 30, but we're not below 20 yet. It's been a while since we've been below 20 on the negative indicator. In fact, it's been since back over here, June 8th, when we just spent a day below it. And that was the peak. And then the negative indicator rallied from there. The positive peak there, and the negative rallied. You know, is that what we're getting again right now? You know, that's the big question. You know, are we bottoming again on the negative indicator? Are we peaking again on the positive, just like we saw there? It looks like a lot of these indicators look very similar to that June 8th peak, a lot more than it did over here when we were breaking out, right? When it busted up here to the upside and busted down to the downside in the negative indicator. That's hardly the pattern we're seeing here. You look at the Ichimoku trend cloud, obviously a very strong trend on SPY. And we are almost there again. See, we got up to 2.65 over here, but couldn't get through it to really establish the trend like you need to, right? You see over here, that's when you establish the trend. We did break through those levels. We didn't here. We're up to it now. We haven't broke through it yet. So, you know, again, another sign to kind of watch to see, are we actually breaking out? And then finally, from a Bollinger Band perspective, we are in the upper quartile in SPY. We are in the upper quartile on IWM, but unlike here where you broke above the upper bands, we haven't broke above the upper bands here, and the bands are already outside of the Keltner channels, right? You can see, so we've kind of lost the opportunity. Really, on August the 27th would have been the ideal day for it to break out above the bands and the Keltner channels and really get that breakout pattern going, because that was the breakout above all those highs. That's the day that, you know, that last Friday that everybody thought, oh man, we're breaking out here. We really didn't, and you notice we haven't followed through, and now we're actually back down below the Keltner channel, and so we're not holding. Very similar to what we saw over here in June, where we were also unable to get outside, you know, to really break out while the bands were inside the Keltner channels. Then the bands broke out of the Keltner channels, and that's where you pushed above the Keltner, very similar to here. That's not really the most bullish breakout pattern. Again, not like you saw over here when the bands were inside the Keltners and you broke out there, and then they broke out. Then you got the green dots, right, and the higher momentum. That's breakout. This was not a breakout. Like, again, we didn't see it. The green dots came further in, and then same thing. This is so far not a breakout either. Let's take a look now at the intraday charts. You know, the short-term charts here, and you see, there we go. You see look how sideways the range was on the SPY this week. Just very, very, I mean, the range, the brown bars are going to be up here next week. very, very light range. Lower high, lower low, but we finished in between yesterday's high and low, so very neutral from that perspective. IWM also had a lower high and a lower low. We did finish above yesterday's low, so neutral in that perspective too. Little slight bearishness because we were closer to today's low than high, but because we stayed above last week's low, and you notice we did fill in yesterday's gap. After filling in today's gap, we filled in yesterday's gap there. So, we still got really the last real significant gap we had to fill is down in here. But we filled in yesterday's gap with today's weakness, and we'll see if that's enough weakness for IWM. Let's take a look. I showed you the range. We need to go right here. I showed you the range and the volume on the SPY. Again, very low, 2 points. The volume at 47 million shares. Let's put those numbers in context. 2 points is well below and already an extremely low average. 40 some odd million, 47 is also well below the 52-week low of the average. So extreme low numbers. And then you can see also in volatility, extreme low numbers in the volatility, back to the 80%. So these are all extremes, which is one sign of a good bullish trend, but it's also a sign of a grinding trend. Like, it's not a breakout trend. It's we're just going as long as it will last kind of a trend. And it most likely will at least last going into September expiration, but not with a whole lot of upward move. As we saw this week, it was very sideways, but not sideways enough that we are killed the trend, but sideways enough that we're still maintaining this positive trend, but just this grinding away at it. So basically, to summarize the technical outlook, we're still strongly bullish. IWM has not broken out yet as much as it looks like it did last Friday. As you can see from the indicators, the context of this price move shows us this is not a breakout move yet, and that still could turn into one, but it's not one right now. And in fact, you would lean more towards it behaving very similar to early June, where that was the peak, and then we had a leg lower to the bottom of this channel. I would expect that again here on IWM, while NASDAQ and the S&P maintain a grinding bullish trend. So a little bit more of the same. We'll take a look at some more charts on a relative strength basis here in a minute. But what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section, especially if you disagree, what charts or indicators you're looking at. Maybe you do think we are in breakout to a new intermediate leg higher. Maybe you're a lot more bearish than I am. Maybe you think we are gonna have a bigger exhale right now, sooner rather than later. What charts are pointing you in those directions? And why, and share those with us in the comment section down there. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, you want us to do another video again tomorrow, or Monday, or Tuesday, excuse me. A quick way to give us feedback if you like our videos. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more information from day to day. There's my handle there at davidsettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, you can check out over here on the right our Market Outlook Live video. You can also access it up here in our menu, Market Outlook Live Trade Review. That's where I go through and I review all the trades and previous Market Outlook videos that I've done. We take a look at whether we should stay in them, close out of them, or how we should manage them. We also already put on today's trade idea from today's video before the market closed. So that's where you can get to that. Here's our upcoming trading rooms here, our next upcoming trading rooms. Of course, you can get to all of them here by clicking on trading rooms in our menu. Come down here, click on this heart. It opens up a new tab. Hit that like button. Also click on this thumbs up icon. Click on another new tab. It opens up another new tab, click on that like button. Again, the more you do that, it really helps us get our content out to all of our followers because of how the algorithms work with these social media platforms. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here while you're watching the video. All right, if we take a look at how the market did today, again, jobs numbers was the number one big driver, well below expectations, of course, damping down expectations of any Fed tapering. which again kind of reiterates the idea that the Fed is willing to let inflation occur. I think that's kind of your biggest factor of what's going on here. If we take a look at like the yield spread, again, for past comparison's sake, we've been in this environment before of indefinite asset purchases with near 0% interest rates. We were that way over here in 2013. And so if we take a look at where the yield spread was back in 2013, again, during this entire period, you can see that the Fed didn't, here in May, the Fed was considering slowing down, right? They talked about tapering. We had the famous taper tantrum. And you can see that the yield spread wasn't high enough. It was barely above 150 basis points, maybe 175. The market wasn't ready for that. So they really backed off, and the market result, and the result was we continued higher until the yield spread got over 200 basis points to closer to 250, and that's when the Fed started to taper, just a taper, much less raise interest rates. They didn't start raising interest rates all the way over here in the fourth quarter, December of 2015 is when they first started to raise interest rates. So the yield spread had already started to come down as the market was starting to price in just the very first one, the very first rate hike. And of course, here's what happened with the rest of the rate hikes. Because we didn't get another one until the December of 2016, and then we just kept going from there into a regular pattern until you had the mid-cycle adjustment in 2019, and of course the COVID drop back down to zero. But we have a period of like very similar to where the rate curve, the yield spread rate curve, got up to 150 basis points. People started going nuts that the 10-year note was up so high, right? And inflation's going crazy, and it was pricing in inflationary expectations. The inflation levels here, if you go to the Analyze tab and you go to the economic data, the inflation rate back in March got up to 2.5%, higher than we've seen. Here we were that high in June and July of 08 when the commodity bubble really peaked and burst. And before that, it was right before the election in August of 2006 was the inflation rate up at 2.5%. And so it was, here we are again at those levels. And so because inflation rate got so high, people said, well, why are we not tapering? But the problem was the yield spread wasn't above 200 basis points, 250 basis points, which is where it normally gets to when you start to worry about interest rate hikes or any kind of restrictive policies. We weren't there yet. And so we had a little bit of a tantrum. Of course, then with the mega cap stocks being a safety trade, that's kind of allowed this risk aversion to occur very minimally in the U.S. stock market because money's pouring into Microsoft, Apple, all those companies that keeps the broader market as a whole up. So we've gone 10 months without a pullback, whereas we have had pullbacks in the NASDAQ 100 twice. We have had a pullback in the Russell 2000. We just haven't had one in the broad market, in the S&P 500 yet. And so I think now what the market has done with today's jobs numbers said, okay, now this puts the Fed back on the sideline and will allow this to get up to 200 basis points or higher before they're really going to worry about interest rate or even tapering, again, like 2013. So if you go back to over here, you can see the dollar dropped, yields rallied, gold rallied, international stocks rallied. That's your typical setup here for a weak dollar type move. And so when you take a look at some of these charts here, especially for the 10-year yield, because remember, with interest rates at 0%, 250 basis points is up to 2.5%. If I can get my keyboard to actually type this in here, let me give you some perspective on that 2013 level back over here. So here is where, again, we had a little bit of a taper tantrum here, and then we continue to rally up to 250 basis points by the time we started even to concern ourselves with tapering. And then once we started to taper, you notice we didn't go up anymore, right? So here's 2013, things really took off, and we started to taper in 2014 into this area, actually over here, and you can see the yields stopped going up with the tapering, and then this is where the tapering ended in October of that year, and then we kind of kept coming down after that. So, but the market allowed the yield to go up, and now here we're at 1.3%. I think the market's going to allow this to go up closer to 2.5, 2.25, 2.5% before the Fed's going to worry about tapering. And again, just for like if I were to zoom out on this, like you think, well, we can't get back to 2.5%. So high. That's doubling where we're at right now. Well, keep in mind going into this bear market in the fall of 2018 when the risk aversion trade, like we were in a bear market. We just again because of mega cap stocks were part of the safety trade, it kept the stock market afloat. But the reality is everything else was in a bear market. From the fall of, especially internationally from the early part of 2018, but here in the U.S. From the fall of 2018, we were up at 3% interest rates on the 10-year note. Going into the COVID drop, we were almost at 2%, and that's after we had pulled back coming off of that. So 2.5% is not that big a deal. In fact, if you go to this big bear market drop, 2.5% or 2.25% gets you back up to the top of this Fibonacci zone. 2.5%, and you're still not even, reversing this move yet with getting above the 78% retracement level. So that's where I think the market's going to allow the 10-year note to go to before we have to really start worrying about restrictive policies. You can see the euro really took off too, and that intermediate line is now up above 60 for the first time in a while. We haven't crossed above that 38% Fibonacci retracement zone. We got a little bit of a long upper shadow, but that's where you're headed. And I think we're probably headed up towards, at least 120, if not up towards this area again before we have to concern ourselves with significant risk aversion from a broad level, right? On a very, very broad long-term level. Doesn't necessarily mean that the S&P 500 has to go up a lot. But it does mean that, when you look at like gold prices here, you expect this will go up with the weakness in the dollar. You expect commodity prices. If you go back to commodity prices here, you'll expect that these will stay bullish in a bullish area. And again, considering S&P is already bullish, it just will keep it from falling. It won't necessarily push us up to, and it might create that kind of parabolic move. That you saw. You didn't really, if I go back to the DMI here, and I go back out, that time frame, so we can see this 2013 level. We never did go like strongly parabolic. We did start to, we got the clusters at the end when they started the taper, and we kind of had some volatility there, but you can see how the ADX really just kind of came down. We didn't do anything. I think we're more in this pattern where we might start to get a parabolic type move, and you can't really see that here because I need to do this. There we go. You can see how 2017 we really ended what was already a pretty mature run with this post January 1st spike in volatility that ran the ADX up, and then that started all that volatility. Remember, the catalyst was not here in the U.S. The catalyst was over in China there in 2018. China is a lot more willing to ramp up, ramp down speculation than we are here in the U.S. And so you can see what happened there, and that started, a multi-month. Again, that's not a big drop looking in context, right? When you go back out, you look, that's nothing. But at the time, that was pretty, we had spiked up pretty significantly. We had gone parabolic, and then in a matter of a week and a half, we had lost multiple months worth of gains. And then we stayed down there for a couple of months before things turned back up again, and then of course finished the year with even a worse pullback. So, that's the kind of element you probably are expecting here going into the end of this year. Where there's a likelihood that we could ramp up on a parabolic move, especially if the Fed is allowed to let this get up to 200 basis points or more before they start to really worry about slowing down those asset purchases and really slowing down risk appetite. They're obviously not very concerned at all about slowing down risk appetite here. When you consider the stock market is at valuations very similar to the tech bubble, the real estate market has got even probably higher valuations now than what you had in the real estate bubble. But instead of the tech bubble and real estate bubble being separated by 5-6 years, we're getting those on top of each other right now. Then you add on top of that the bond market is really strongly bullish. Like the long-term bond prices are very high compared to where they've been historically, with rates down to 1.3, 10-year note down to 1.3%, and then the inflation rate as high as it is right now. So when you put all of that into the equation, again, you can see how we're not really too interested in damping down speculation or risk appetite here, because pretty much everything, even crypto currencies, are at really strong and high abnormal valuations that you could say, along with all the other more speculative asset classes that are out there, whether they're NFTs or whatever else anybody wants to speculate on. Even like art, whatever the case is, it's, whatever the asset class is, there are really high prices for those, for anything people want to try to speculate on. Let's take a look at the sector moves here, and let's take a look at how they performed today in reaction to, oops, not that one, in reaction to the jobs number. And you can see, it takes me a minute to see all these different charts here. I need to get rid of some of these. But when you take a look at just how the market performed today, 2-minute chart. You can see, again, the safe haven sector right now. I mean, that is pretty much the safe haven sector that's out there, is technology. And that was really the only outlier to the upside. To the downside, materials, industrials, financials, energy, and utilities for that matter. But all your cyclical areas were all the bigger losers to the downside, while technology stayed strong. So, you can see where safety is. I mean, this healthcare stayed up. Real estate stayed up. Those are safety areas, but of course the biggest safety area is here in that, up here, in that QQQ IWM name. You can see how we finished back above. We've been dipping here lately on a relative basis, but QQQ is moving back up relative to IWM. If you take a look at QQQ here on this chart, but then come down here and compare it to IWM, and compare this one to IWM as well. So there's the Qs. You can see riding above the 50-day moving average relative to IWM. We've come back down. We're losing some momentum, and we're losing relative strength. But you notice, when both lines are below 100 and moving lower, then that means they're in the red quadrant here. And you see how they're not doing that. So they're right now in the yellow quadrant, which is the weakening, but not lagging yet. So the Qs is still outperforming IWM. And you could say, if I were to look at this from the other side of the equation, IWM relative to, come down here and change it to QQQ and change this one to QQQ, then you can see how we are below small cap stocks, which would be industrials, financials. Like, those sectors are more correlated with these small cap stocks. They are lagging behind and still haven't crossed above that 50-day moving average yet. Just to kind of give you some perspective on that, you can see we had been below it for quite some time. We had been above it for the end of 2020 going into the beginning of 21 before coming back down with this relative weakness. And we haven't turned it back around. Now, it's in the improving category. You have both lines rising. The momentum's above 100, but the relative strength's not. That's what puts it in the improving category. When they both are rising above 100, that's when you're in the green. And when you're tack onto that you're above the 50-day moving average, that's when we're like, okay, IWM is starting to outperform again, and not the case yet. All right, so for our trade idea of the day, I wanted to take a look at tech resources here. You can see yesterday, this stock broke above recent highs with the cluster. So the intermediate line got into above 80 with the cluster to kind of really solidify that move. You also see at the time, again, we were about what, 8.25% above. Remember, the Russell 2000 was only like 1.5% above or 2% above when the 80 line, the intermediate line crossed above 80. So you can kind of see what a good strong breakout move looks like when you are at least on that market forecast chart. And you can see too from the long-term perspective here, you'll notice that you got a good bullish candle after multiple. This is the first bullish candle we've had in a long time, because you've had either bearish candles or neutral candles. Very strong bullish candle. You can see the size of the candle got up to 8%. So very strong move from that regard. If you take a look at the 3 green arrow chart, you can obviously see we got 3 green arrows here, and you notice on that breakout move we got an increase in volume. Again, really trying to solidify that move. If you take a look at the two line versions of the MACD and stochastics, you can see that we got all the moving averages lining up. The 30 days about to cross up above the 50-day there. The MACD is diverging, still moving up higher. So very good move from that perspective. From some of these other indicators, you notice from a directional movement index, we are almost below 20, lowest that the negative has been in a long time. And then your positive is well up above 30. The ADX is starting to rise there. You take a look at the RSI and the CCI indicators, and you notice that we are well above 60, and we are above, not quite above 200, but at least above 150 there on the CCI. We broke through the Ichimoku cloud, easily broke through the Ichimoku cloud, and we have a weak bullish trend that's getting closer. Probably we'll get to the 2 level here and the 65 level here for the first time in a while on Tuesday. And then of course looking at the Bollinger Bands, especially when you look at them in conjunction with the Keltner channel, which is how we found this. This is what we talked about in our technical analysis. This is what we talked about in our technical analysis class on Friday, that we broke through the Keltner channel yesterday on that breakout move, and then really solidified that with this break above the upper band, really close to the upper band there, and well above the Keltner channel. So very strong, and the Keltner channel, the Bollinger Band is now breaking out and widening out. Very, very strong bullish move for this stock. So again, so what we decided to do on this stock was to do a bull put spread. You can see we sold the 24, bought the 22 strike. In doing so, right now you still got a pretty, typically we're only shooting for about 50 cents on that, so we're pretty high. That's a pretty high credit for that trade. So this will give us the ability to see, okay, is this breaking out? If it is, it should keep going up, and then we'll get filled in as it keeps going up, or at least it will hold this, and that credit will move its way down to 50%, get to a point where I have, because again, as credit falls, probability rises, probability of success rises. So it will get down to a credit where I want that probability of success level. So we put a stop limit order there at 50 cents. That's currently working here at 50 cents, and that will get us to the return that we want. You can see we put a full position size on that and get us over that for $1,000 of risk, about that $300 of reward that we typically shoot for. All right, well that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as to our website at marketscholars.com. Click that thumbs up icon, like us on Twitter and Facebook as well, comment on the video. Have a great rest of your holiday weekend, everybody, and we'll see you all next time.